Hello, I'm JP Powers, Chief Investment Officer for RWA Wealth Partners. Thanks for joining me for this month's market update. It's been a busy stretch, so let's get right into it. 3 things stood out this month. After a stellar run, the AI and chip trade has cooled off, both here and overseas. We have a peace deal that is still coming together, but oil prices have come back down to earth, just as inflation fears are putting our new Fed chair in an awkward spot. And perhaps the biggest headline was the SpaceX IPO that went from the hottest trade on the street to a cautionary tale in a matter of days. Let's start with the equity markets. The S&P 500 has held up well and it remains near its highs for the year, but the incredible rally we saw off the March lows has certainly cooled off now. And it's worth looking past the US for a minute because this story isn't just a domestic one. Emerging markets have actually outperformed the S&P 500 by a wide margin this year, and much of that outperformance has come from South Korea. That's been driven largely by Samsung and SK Hynix, the 2 companies that make most of the world's AI memory chips, which have been on an extraordinary run. And that run had pushed the Korean market up over 100% year to date. And with Korea and Taiwan now making up more than half of the MSCI Emerging Markets Index, it's become exactly the kind of concentration that historically can cut both ways. When the same worries that hit US chip stocks this month spread to Korea, those 2 stocks fell more than 12% in a single session and dragged the broader Korean market down with them. Some of that selling has been compounded by index mechanics. Korean chip makers had grown so large within emerging markets funds that many managers were forced to trim positions simply to stay within their own risk limits, regardless of their actual view on the stocks. I take the same lesson from this as I would from the US chip story. It's a reminder of just how concentrated the AI trade has become, not just in our market, but globally. A handful of companies on both sides of the Pacific have been doing an outsized share of the work. And that's worth knowing whether you're looking at your positioning here at home or your exposure abroad. Let's turn now to the latest on inflation and news out of the Federal Reserve. The most recent producer price report came in much hotter than expected. This measure is similar to the CPI, or Consumer Price Index report, except it looks at prices from the producer's side before it reaches the consumer. The June PPI release showed inflation up 6.5% from a year ago, the fastest pace since late 2022. Much of that acceleration traced back to energy, and we've now gotten relief there as the peace deal with Iran has come together and brought oil prices down in a hurry. But the core measure, which excludes food and energy, was still up just under 5%. So while backward-looking inflation data is still running hot because of the war, we should expect these numbers to look better in the coming months. That's giving new Fed Chair Kevin Warsh some breathing room, but not much. He was brought in with expectations to favor easier policy, but he can't credibly cut rates into inflation data that's still running so hot. And his own committee is actually leaning toward a hike this year. For now, Warsh has chosen not to publicly break with the committee while also making clear he wants to run a more old-school Fed, with less hand-holding and no forward guidance. He's showing a preference for letting markets react to incoming data rather than trying to anticipate how the Fed will respond to it. For us as investors, that's the real headline here. A Fed that's going to tell us less about what it's thinking, right when the inflation picture is genuinely confusing. Hot on paper, but perhaps improving underneath. I'd expect more volatility around every inflation report for the foreseeable future, simply because the Fed isn't going to pre-position the market the way that it's used to. Now for SpaceX. The company's IPO priced at $135 a share and was by nearly any measure the largest in history. Within days, the stock had run up well past $200, briefly making SpaceX more valuable than Amazon and Microsoft. Management didn't waste time celebrating. They quickly announced the $60 billion acquisition of the AI coding company Cursor, paid for entirely in stock, and then turned their attention to another cash raise from the bond markets. That's where the air started coming out. The same week SpaceX received investment-grade credit ratings, which is usually a vote of confidence, the stock fell anyway. And when the company confirmed the bond offering to refinance debt taken for an earlier acquisition, the stock fell sharply again. All told, SpaceX gave back more than a quarter of its value from the peak in a matter of days, even though it's still trading above the IPO price at this time. I'd put this in a familiar bucket. When we go back to look at the results from several high-flying IPOs, they can be mixed, but almost always there is a significant drawdown of 40 or 50%, sometimes more. Now that's not a prediction, it's just highlighting that the first few days of trading tell you almost nothing about where a stock lands 6 months or a year later. What comes next for SpaceX is the company actually having to prove the valuation, how it funds growth, how much debt it's willing to take on, and eventually, how much stock becomes available to trade as those early lockups expire throughout this year. None of that means the long-term story is broken. It just means the easy money may have been made when the company was private. And the next leg is going to be a lot more about fundamentals than hype. I'm sure insiders and early investors at OpenAI and Anthropic are chomping at the bit to get their own IPOs done while the market appetite is still there. But we'll have to cover those in a future update. So that's the month. An AI trade that cooled off and showed just how concentrated it's become both at home and abroad. A Fed that's tightening their communications just as the inflation picture is becoming more muddied. And a hyped IPO doing exactly what hyped IPOs tend to do. None of it changes our long-term approach, staying invested and diversified, not overreacting to a single headline. This is exactly the kind of month that rewards having that discipline already in place. If you have questions about how this is impacting your portfolio, please reach out to your team here at RWA. Thanks for joining me, and I'll see you next month.